we've called this promoting resilience through index insurance the way forward. Just to give you a hint of where we're going, part of the way forward is not to, we're going to argue, is not to solely rely on index insurance. So we're going to talk a lot about index insurance, but we're going to come back around and think about other complementary kinds of interventions that maybe can deal with the central problem. Alon suggested over breakfast this morning, the challenge here is to slay risk, not so much fixate on any particular, if I keep the military metaphor going, in any particular weapon, that risk is the problem. And so we're going to share with you what we've learned. I have at the end of this slide presentation, I put together some tables yesterday, and I realized in the SSM Market Innovation Lab, we've participated in about 20 to 25 index insurance projects, and they're sort of listed at the end. And we've been whacking away at this for a while, and so we're trying to share with you today what we've learned. We've passed out a little brochure that includes a summary brief of this presentation, as well as 4 or 5 other briefs that talk about some of our more recent work in this area of slaying the risk beast. So let's just, if we could jump right forward, then that would be great. So I'm going to first talk about the potential, the problem, and the way forward. So the potential here for index insurance is there. There's ample insurance that traditional insurance, and by traditional insurance I mean like what all of us probably have for automobiles or your house. You have an accident, someone has to come out and verify the loss. There's ample evidence going back into a lot of efforts in the 70s that that's a really bad idea when it comes to low wealth producers. It's just way too expensive. The government of Ecuador had missed that memo, and we did a project with them a couple of years ago where they were trying to do indemnity-based insurance with small-scale farmers in Ecuador. And we actually showed dollar for dollar they could have provided much better protection using index insurance. Not that index insurance doesn't have its failures, but most of the premium dollar was just being dedicated to the cost of verification as opposed to actually paying out payouts. Anyway, there's plenty of evidence on that. There's, I'm going to call, as opposed to ample, I'll say modest evidence that index insurance works. And the way I like to talk about it, you can think of the impacts of index insurance, or more generally risk removal, as we go through this, as impacts that happen before bad weather events happen. So when people are confident risk is removed, then they may respond in time. And across a series, about 5 or 6 studies that span those countries, we typically are identifying 20 to 30% investment bumps. It should imply, for at least for the cash side of these households, 20 to 30% increases in cash income, simply from removing risk. So another way to think about that is that it's not that any technological innovation other than the insurance was needed. Those opportunities are there. People are not seizing those opportunities. So you can sort of say, well, insurance is expensive, but not being insured is expensive as well if you're giving up to 20 to 30% of your income every year as sort of a protective strategy, not taking too many risks. So again, it's very interesting, I think, to all of us that insurance seems to have this ability to crowd in sort of greater entrepreneurial level activity for people who otherwise would have to be very, very conservative and keep their resources around. In event of a drought, now they can deploy them more entrepreneurially, if you want to put it that way. There's also evidence after the drought. And this is a harder thing to study because you have to wait for something bad to happen. The index-based livestock insurance project in Kenya gave us a first bad thing in 2011. And what the impact evaluation of that shows is quite substantial reductions in the costly strategies that people employ in the absence of insurance. So people are able to feed their kids, and people are able to hold onto their productive assets in really quite striking and large ways. So that's the potential. Now the problem, if we can sort of slither down here, the uptake of insurance is often a little bit on the low side, and sometimes very much on the low side. And the question is sort of why. One problem is the contracts themselves are of sometimes dubious quality. We'll come back to this. They're failure prone. Another problem is the contracts are often fairly highly priced, and again, we'll talk a little bit more about that. There may be a lack of trust in the providers, the suits as I've called them here. It's a new technology, and as Alon has put it a long time ago, and I always like the way, when a small-scale farmer deals with a bank for a loan, the bank has to trust the farmer to repay. But you turn the tables when you have insurance. The small-scale farmer pays the financial institution, the insurance company, and has to trust that the financial institution will come back and pay the farmer when the bad weather event happens. And given asymmetries in power, education, ability to use the legal system, you can understand why trust can be a really important issue. It's a novel, complex technology. It's hard to learn about. That may be a problem. Cash constraints to its purchase may be a problem. and a series of things. I've just called them here behavioral oddities. And that's really that's maybe language that makes most sense to economists. Those of us who studied economics probably had to prove at some point that a risk-averse person will always buy actuarially fair insurance, and that's under a set of assumptions about how people behave. But of course, people don't really behave that way. So the way people really behave is considered an oddity by economists because they're refusing to do what we think they should. But there's some very interesting work out there on that, particularly in relationship to index insurance, which offers some insights about doing it a little differently. It's not necessarily that it won't work, it just has to be done a bit differently. So I think our bottom line on index insurance is it's a work in progress. It's promising, but it's got some real serious problems. So here's our way forward. And one of the things that's in that little folder, we have a brief that summarizes this. So we tried to ask ourselves, given what we've learned, what are the kind of the 6 things that we think should be focal points, especially for USAID? And so I'm going to talk about the first 3, which is investing in the development of high-quality insurance indices. Second, requiring in some way that contracts meet a safe minimum standard for insurance quality. And third, doing something about the pricing of insurance and the use of subsidies in relationship to that. So I'll talk about those 3 things, and then Alon's going to jump in and talk about the possibilities of bundling index insurance with stress-resistant agricultural technologies. Talk a little bit about bundling insurance with credit and savings mechanisms. And we're going to get some very specific and exciting examples of using these other mechanisms to slay the beast of risk. And then finally, challenges and things we might learn from the microfinance revolution that could carry over to a microinsurance. It's not a revolution yet, but to making microinsurance work better. So let's just jump right in about the quality of index insurance. So this picture is kind of ugly, comes from a paper by Daniel Clark and Olivier Mahoul at the World Bank. And it's meant to illustrate, so this is based on actual data from a rainfall-based index in India. This is an average year across a number of areas in India. These are good years, these are bad years. And this line here is the statistical estimates of the payouts that farmers receive as a function of the state of the world. So what you'd like to see, a sort of perfect insurance contract would offer 0, 0, 0, and then it would go up very sharply when the state of the world gets bad. If people were buying lottery tickets, right, that had a 1 in 10 chance of paying off, you would actually see a perfectly flat line because whether the lottery ticket pays you has nothing to do with whether it rained or not. It's just a pure random event. So if you look at this pictorially, this is much closer to a lottery ticket than a perfect insurance contract that would look like that. Okay? Now that failure of contracts to pay when losses are highest, that's sometimes called basis risk, and some people talk about basis risk events. Basis risk events means the insured farmers are really angry because they thought they had losses and they were getting practically no payments. Okay? And that's a serious problem. So there's recently been kind of spectacular examples. The most recent one I heard about was the Africa Risk Capacity was using index insurance. I think it was Malawi said we had big drought problems, but they weren't paid, and they said, what are you talking about? Come see for yourself. So that's a basis risk event, an insurance index that didn't properly trigger, at least in the eyes of the insured party. You can always sort of debate about did the insured party not understand or whatever, but the fact of the matter is this is a serious kind of issue. So let's jump ahead to the next slide. And just sort of a way to think about it. So the lottery ticket I showed you, we could think of this way. So this little dotted line that you see through here, this is sort of the yields people are receiving. This is their income. And if there's no insurance, then your income just collapses as your yields collapse. Okay? A perfect insurance would say, we're going to put a floor under people. That's the idea of insurance. You want to stabilize, you want to give people an insured income so they can take chances. And they know they can feed their families when yields are 20% or 30% of normal. Okay? The insurance contract I just showed you is just going to run roughly parallel to that uninsured line. The perfect insurance contract would look like this, and the technological challenge, as you will, is to find an insurance contract mechanism that gets closer to this perfect concept than not. And there's lots of ways to think about measuring the quality of the contract, and I don't want to get too wonky on that, but pictorially you can kind of see that these gray areas, for example, blue here is just an imaginary index insurance contract that's not terrible but not perfect. You know, the sizes of those blue areas might be thought of conceptually where the contract falls short of a perfect insurance contract. Okay, so let's jump ahead. So we recently had Cesar Chavez Day in California. So if you remember the expression, si se puede, yes, it can be done. So can you design a quality index insurance contract? And my answer here is yes, it can be done. Okay, so we can do better than that first graph of lousy rainfall contracts that we saw in India. And here's just an example of some work we did in a rice growing area of Tanzania. So this is the plot level yield at the farmer level, okay? And this is the probability that the farmer receives a payout. The red line here is if you had what's called an area yield contract, where you go out to every area and you estimate average yield sort of at the village level, and then payouts occur. And notice that's not perfect, right? So there's roughly, if farmers have really bad yields, this is saying there's a 70% chance that they'll get a payment, but there's a 30% chance that they had really bad yields, but on average their neighbors did not. So that's going to be an uninsured component of risk. Okay. Now the other line, which you can barely see here, the blue line, that's actually what we got using remote sensing data from satellites. Okay, so we spent a lot of time working on this. So if you can just slide just a tiny little bit more. So here's what we did. So how did we come up with a cheap to measure satellite-based index? So we did a couple of things. First, we used a ground truth-based design. So we got retrospective data on yields from farmers going back roughly 10 years. We used machine learning for what's called crop detection. So we could figure out which satellite images were actually rice fields versus which were not rice fields. So that's called crop masking or plant detection, right? And then we also did planting date detection. So you can ask the satellite, when did stuff get planted? And then you start the biological clock, because the rice is going to start growing from the 1st of December, if that's when the field was flooded and planted. And then we went through a massive quantity of potential predictors of plant growth. The one we settled on is something called gross primary production. It's based on these 3 underlying indices. Let me skip the lumpiness in the interest of time. So one thing is the measure you use, and the other thing is the resolution at which you use it. So we're working with what is called 250 meter by 250 meter pixel resolution, so that's about 6 hectares. So that means for every 6 hectare block, we get rid of the blocks that we think are not rice fields. We think we figure out when they got planted, and then we look at a measure of gross primary production or biomass growth over the growing season, okay? And that's what we use to create a predicted index of yields, okay? So that's an example, and what you can see here is this index works almost as well as an area yield index, except you don't have to pay people to go out there. You just push a button. We've got the computer program already written, and it sort of runs itself from here. Okay? This kind of work is continuing. We just got, from the Global Development Lab, just gave us a grant to work with super high resolution imagery, 2 meter by 2 meter pixel, which I think we can do even better. So this is still a work in progress. So could we go ahead? So this is just more, so basically the point is this is just showing both the strengths and the weaknesses of our satellite-based predictions. The satellite prediction is not perfect. It tends to over-predict yields when conditions are bad. The satellite agrees things are bad, but it doesn't always get right how bad they are. And so what we've developed in a project now is we're doing what we call an audit-based procedure. So we tell farmers what the payout will be or what our predicted yields are. If they think we're wrong, if they say, you say we got 60% yields, but it's actually 30%, come see yourself. We said, okay, we'll come and see. Okay? And so that obviously costs some money to do that, and we just piloted this in Mozambique, and we're doing it next week in Tanzania. We're actually implementing these things. But our estimate statistically, based on the data we collected, is that 1 out of 5 loss events, it will be necessary to do an audit. Okay, so that's the level of refinement. We think we can improve that with this super high resolution stuff, but 1 out of 5 isn't bad, because bad events don't happen every year. They happen 1 out of 4 years, roughly. So we're talking about a relatively low level of audit. The audits are not cheap, but you can add them into the price of the insurance. And if you don't have to do it very often, it's not going to be very expensive. Okay, so let's slide on. So that's just a little warm-up that this is an area that's advancing quickly. We're experimenting with drones, for example, for super high resolution, 2 centimeters by 2 centimeters, if you want to go to that level. So there's a lot that can be done to improve the quality. So the next question is, if we have quality, how do we know it? Or if we don't have quality, how do we know it? And so we've been talking in the AMA lab for a while about how would you define a safe minimum standard for insurance quality so that you could say, is it good quality? And the way I've often tried to motivate it is this, that we can think about insurance in something like hybrid maize seeds, which we're more familiar with, as being kind of similar. And they're similar in this way. They both have a hidden trait. A farmer, like the woman I showed in that second slide, the woman's holding her insurance contract. She can look at it, right, but that doesn't tell her how reliable that insurance really is. Similar, that woman could look at a maize seed and she'd say, well, supposedly Monsanto did some great things in here, but I can't tell by looking at the seed. I will only know experientially. So we have this problem with hidden traits. The consumer can't just look at the thing and tell for sure if it's going to work. And secondly, quality is expensive to develop, right? So the work that I just shared with you is an example. With the gracious support of USAID, we've been working on this to get better quality, but it took fixed investment, just like it takes fixed investment to create high-yielding maize seeds. The difference, though, between index insurance for agriculture and hybrid maize seeds is there aren't defined and enforced quality standards yet out there for agricultural index insurance. There's regulation of a certain sort in the market, but that typically is only, does the institution have enough resources to cover their liabilities? It doesn't say whether they're selling a junk insurance or not. And notice that's very, very different to maize seeds. Every country I go to, we were just talking about Kenya a second ago, right? In Kenya, if you want to sell certified maize seeds, it has to meet certain standards. And their germination test and their yield test, and it's all certified. Okay, well, we don't have those standards right now for this technology. And in fact, it's a technology that I would argue needs it even more than maize seeds. Because maize seeds we can learn about fairly quickly. If I plant maize seeds in 1 year, I can see what happens. But insurance, I might have to wait 5, 6, 7 years before a bad event. And then I actually find out how well is it really working. So it's really hard to learn about. So for me, that suggests that quality standards are really important. If you take those characteristics of index insurance as a commodity and you put them into a model, it's easy to, and I think the intuition is pretty clear, you can imagine an unregulated market might actually end up just supplying junk insurance. Because it's expensive to develop non-junk insurance, but if people don't trust it anyway, you'll never get a return on your money if there's anyone offering junk insurance, so it's just going to be cheaper, right? So there's a couple of reasons, given the nature of this technology, that some kind of good housekeeping seal of approval mechanism might be needed. So let's go ahead. So again, let me skip over the basic idea. Basically, we can use. Let me skip over the detail. We use some standard ideas from economic theory and say we can develop something called a reservation price. That's the maximum price someone could pay for an insurance contract without making themselves worse off. Okay? And we can define the safe minimum standard is the market price had better not be higher than this reservation price, because if it is, the person really should not be buying it. Okay, so it's kind of a simple, it's a little bit technically complex. In the AMA, we run something called GAN, the Global Action Network on Agricultural Insurance, in collaboration with the ILO. So in that context, we've created a little spreadsheet tool that if you've collected the ground truth data that you need to design a good contract, you can just plug it in, and it will do calculations for you about whether this contract, one contract or the other, does or does not meet a safe minimum standard. So those are doable kinds of things. So I think kind of a first step here would be for donors and USAID in particular to think about is not only continuing the support for the development of quality index insurance contracts, but also sort of think about what's a way to start pushing on safe minimum standards. Because right now, the industry is not pushing for it. I've talked to lots of insurance industry people. I say, how come you guys aren't pushing for this? Because it's not really in your interest to have junk insurance out there. Okay? But somebody kind of needs to get it started, and a way to possibly do it would be new projects maybe should demand that contracts pass an SMS-like test. Okay? So let's skip on. And the last point I want to make has to do with pricing. So the diagram I just skipped over was actually an SMS analysis of the contract I was illustrating in Tanzania. Okay? Basically what that showed is for a moderately risk-averse person, their reservation price is somewhere 40%, let's just say, above what's called the actuarially fair price. Actuarially fair price is the price of insurance which would just equal the expected payouts over the longer term. So if I pay $100 a year, then the actuarially fair price means, if it's 100, means I would, on average, get back exactly $100. Now, obviously, insurance is not sold at that price. because insurance companies need to cover their costs, and the amount above the actuarially fair price is what we're interested in. So what we find is that for that, and a farmer will pay more, the reservation price, the higher quality of the insurance is, the higher will be that reservation price. But in the case of that fairly high quality satellite contract, farmers would be willing to pay up to 40% more than the actuarially fair price. The problem is, when we look out at the, as I mentioned, we've done about 20 some of these projects. When we look out at them, the markups are often over 50%, okay? And you go, well, wait a minute, that's getting to be kind of expensive. And farmers obviously certainly agree with that. If you look at U.S. crop insurance is sold at about 27% over the actuarially fair price. So we're looking at markup rates that are easily double of what we see in the U.S. crop insurance market. Now, as you all know, U.S. farmers don't pay that price. It's subsidized tremendously, but the starting point is 127%. It's regulated actually by USDA in order to qualify for subsidies. Okay? So we can sort of worry about what are the reasons for these extraordinarily high markups. Insurance companies would say, well, the data's bad, there's climate change, probability distributions are unstable. But the reality remains that in many of the projects that we look at, we see markup levels that make me wonder if farmers actually should be buying this, unless we can get a really high quality contract. So these things sort of operate together. So let's go on. So there's interest in doing something about this. The IFC and World Bank have a program called GIF, Global Index Insurance Facility, that's been providing subsidies. They just announced a new program that I think actually makes more sense. Again, in the interest of time, let me not go too much into the detail of this, but I think there's a smarter way to deploy whatever public money is put into subsidies than has been done so far. And I think that has to do with saying, why are they so expensive? It's because insurance companies are worried about the tail end risk. They think the data aren't good. They think climate change is making big loss events more probable. So I've kind of been arguing for a while, well, then just have a public entity provide the reinsurance on that. And actually, GIF just finally did that in a program that was just announced in combination with Africa Re, where they're saying, okay, the private sector basically covers the cost of insurance and payouts up into a certain loss ratio. Loss ratio is just how much you pay out versus how much you received in premium in a particular year. And then beyond that level, so if things are really bad, then this public facility is actually going to pay the cost of payouts. Okay? So they didn't quite set it up in an insurance-like way, but I think that's starting to move in the correct direction. So just to, I want to pass it over to Alon now, but to sort of summarize there, index insurance quality of it is not a given. It's tough. It takes some work. There's still work to be done there. We're making progress. Number two, I think the nature of the commodity in the market, we need to think about standards, and somebody other than me has to say that because nobody wants my good housekeeping seal of approval. And number three, the pricing issue, even in a fairly competitive international market, is less competitive than you might think. And I think there's at least an intermediate strategy to think about a public sector. So I know AID has had a program, what's it called, DCA for credit for a long time. Maybe there's a role for a well-designed DCA-like program for something like insurance. So those are some thoughts on insurance, and Alon's now going to broaden the scope for us.